Welcome everybody to our quarterly town hall meeting. I want to thank you for giving us some of your time tonight. We don't expect to go more than maybe a half an hour or so, but it's a great chance for us to be able to share a few thoughts and ideas. And speaking of ideas, I want to float a new word that I've developed over the last couple months and see how this goes over. So feel free to type your comments in the chat bar. Just be very kind, please. I'm very sensitive. The term is Zoomitis. And how I would define Zoomitis is the condition where you've had so many Zoom calls over so many months and so many days that you really begin to not care about what your house looks like in the background, what you're wearing below the waist, when you've last taken a shower, whether you've got, a half-eaten peanut butter and jelly sandwich next to the computer. So I think that word, hopefully, with enough use, will find its way into the dictionary one day, and you'll remember where it started. So there you go. Anyway, so I think what we're going to do tonight, as we've always done before, is have Brandon spend some time talking about the economy and the market, and then I'll come back on and talk about a couple of financial planning tips and ideas as it relates to taxes and some of the things that we think about towards the end of the year. Speaking of end of the year, it's hard to believe it's October, right? I mean, the days are getting shorter, the temperature is getting a little more crisp outside. Definitely beginning to feel the drawdown to the year here. So I think with all of that said, Brandon, do you want to go ahead and get things started here?
Yep, sounds good. Thank you. Thanks to everybody for joining us here again for our quarterly updates. Hopefully these are helpful. I know it's kind of nice just to get everybody in one place and share this all kind of in one go here. So hopefully this is helpful. We'll continue to do them. I love that term, Adam, Zoomitis. The good thing about that is, I think I have it. It may not look like it from here up, but who knows what's going on the bottom half there. It could be sweats, who knows. So I want to thank you guys all again for joining us. Adam's got a good point. It's been a tough year, to say the least, with this coronavirus. Now we're gearing up for the fall. Thankfully, we've had a good summer here to some degree and, been able to enjoy the sunny months. But here we are gearing up for some shorter days, darker days, colder days, maybe a few months straight of rain, let's call it, and tough times. So I think things are going to be a little tough. So wishing everybody safety and sanity, I guess, through the coming months. But let's maybe start by talking a little bit about where we've come and then where we are, and then we'll dig into kind of what we're looking at ahead here. So, just to kind of recap a little bit what we've seen in 2020 is we had this great 2019, as everybody probably actually may not remember because it feels like it was forever ago, but a great year in the markets. 2020 started off continuing on that theme. It looked like things were going to go really well. And then, of course, we get hit with this pandemic and we saw this huge drop in the markets. I think, at the lows, some of the US markets were down 45% or so. Since then, we've had, thankfully, to a lot of stimulus, a lot of Fed easy monetary policy. We've had this very quick rebound, which we got back up to all-time highs, I think around August or so. So we had this really quick rebound, and now we've kind of seen where we're maybe hitting a little bit of a lull and kind of just going sideways. So it's been really interesting to watch. Since August, we've really been in this kind of tight range where we haven't gone anywhere. If you look back about a month or so ago, we hit the all-time highs. And here we were just 3-4 days ago, maybe hitting those highs again. I think, if you look at the media and, some of the news around there about the markets this week, it makes it sound like the world is ending, the sky is falling again because the markets are down. But the reality is we just hit that ceiling again. And I think we're kind of bouncing off that right now. So I think that where we are now is going to be a pretty telling time, whether we go through the top of that and then continue, or through the bottom and maybe see a bit of a correction is yet to be seen. But pay attention, I guess, is where I'm going with that. And I think that there's a lot that will come from let's say through the end of the year in terms of what may be ahead. I think one of the things that I really want to touch on that has brought the markets up to where they are is all the stimulus that we've seen. So as you guys are very well aware, the stimulus bills and the Fed's policy and all this stuff has been a huge focus for the government. I think we're somewhere near 10 trillion and with some more stimulus on the horizon. And so that has really helped us to rebound quickly, as you might imagine, right? We add $10 trillion into the economy and, we can certainly see some quick impacts of that, right? It's kind of like a injection into the economy and the markets. The thing that I found really interesting, I ran into this the other day, was the world GDP is down about 4% based on the pandemic. That's about 6 trillion or so, give or take. So don't quote me on that, but roughly 6 trillion. And again, here in the US, we're at about 10 trillion that we put in, given what's gone on. So I found that really interesting, right? I'm not saying right or wrong, but I think it is really telling of what we are willing to do to make sure that this economy stays on track and that the markets continue to grow. So it's hard to argue against that, if that makes sense, right? If that's the case, it's very possible that continues and we see the markets continue to pick up from here. One of the things, though, that we are watching with all that spending, as we had talked about last time, is inflation. So I want to talk a little bit about that, because I think that if you hear the news on inflation, the data that's out there, you'll hear that really it hasn't gone anywhere. But if you're like me, you may be noticing that your bills, your shopping bills, your grocery bills are actually going up. So the key to understand that is when we look at the government's measure of inflation, there's really different categories that fall into that. Some of the areas include things like travel, leisure, like housing outside of your primary residence, energy, for instance, right? Fuel costs. Those areas obviously are not going up because nobody is using those services or those products. But we're also not experiencing that for ourselves. Like, we don't feel that in the day-to-day budget because we are also not using that. All right. If you look at the flip side, some of the other categories include things like food, cleaning supplies. What's another one? Anyways, those types of goods, right? And those areas are inflating significantly, right? If you go to the grocery store and buy some meat, you may notice, and you may have already noticed, that it is up quite a bit from where it was before. So although the government measure of inflation may not show a huge increase, I do think that we are starting to feel that already and really feel it in the stuff that we are actually spending on day to day. So I think that's really important to keep an eye on. And again, just like we talked about last time, that may mean making sure that we have equity exposure or things that can help kind of keep up with inflation over time. As we talk about where we've gone, I want to kind of step back a minute and share with you guys, and I know for a lot of you, you've heard this before, so bear with me a little bit, but I want to step back and share that there are really two ways that companies create earnings. They can create earnings from sales, the traditional way, or they can create earnings from financing, right? And really what we've seen is, because interest rates have been held at zero, right? A lot of these companies are creating a lot of their earnings through financing. It costs nothing to create that. And so what we've seen is this increase in prices. Think about like the tech companies, right? A lot of those earnings are, maybe from buybacks or whatever the case might be. And so we can really finance our growth. And what that means is the valuations don't really, I don't want to say don't matter, but they don't really matter. They're not what they are when we have higher interest rates. Let's put it that way. So that's really what's catapulted this kind of V recovery. And now we're at a point where I think we really need to start seeing some fundamentals pick up too. So we're moving into earnings season, and I think this is going to be really critical. We've had this quick recovery. We've kind of slowed off like we talked about. And now if we start to see earnings actually beat the expectations, it's very possible we see that next leg kind of continue up, if that makes sense. So I'll kind of pose this question. Obviously, you can't answer this directly, but if you're thinking about a place where earnings might beat expectations, where might you look? And really what I'm getting at is you may want to look at quality or value type of companies, right? Those are the companies that have been impacted by the coronavirus. now that we're kind of getting back to, getting back to opening up, some of those companies, the earnings expectations may be much lower and may not need to, let me put it this way, it's a low hurdle for some of those companies to jump over. So some of the stuff we've looked at is that. Now, we haven't increased the exposure to value stocks a lot, but just slightly taking some of the chips off the table for the companies that have done really well, and making sure that, that we're getting back to the proper position and able to take advantage if those earnings start to expand a little bit. I think that, as I kind of wrap up here, the thing that I want to maybe share, we're gearing up for the election. I'm sure that's, and actually, I think, thank you guys for joining us, because I believe you're missing a little bit on that front right now. So really appreciate you all for joining us in this. But the reason I bring that up is that there's going to be a lot of this headline news. I know we talked about this a little bit last time. And so I think the markets, and I'm not saying up or down, but there's going to be a lot of volatility to come. So I guess the theme for right now is really to try and make sure to keep that patience. We've done a lot to make sure to peel some risk off the table and have, a defensive posture while still making sure that we're not missing out. But there is going to be some volatility in the next month or so, I think. And so it's really important to remember where we're going, right? Weed out the noise, weed out the distractions, know that there is some defense in place, and that we're really aiming for the long-term goal to make sure that we don't get sucked into this day-to-day craziness that may be on the horizon. So again, I'll turn it over to Adam there. Thank you guys all again so much for joining us. I think I'll have a chance to wrap up here as we finish up, but with that, I'll turn it over to Adam here.
Okay, great. Nice job, Brandon, as always. So I'm going to switch gears a little bit, and what I'd like to talk about is, from a financial planning standpoint, what are some of the things that come up towards the end of the year? And one of the things that has come up every single year, regardless of pandemic or election, is this concept of Roth conversion. It gets talked about during the year, but I think as the year draws down, it becomes more and more important to consider. So I want to take a few minutes and maybe talk about what that actually is, how it's done. I'll apologize in advance because there's a little bit of an assault by some birds back here, so hopefully that we won't have any problems. But I think most people that are listening right now have certainly heard of a Roth IRA or a Roth 401k. And the IRAs themselves, they're individual retirement accounts, and they were developed to help individuals save for later use, right, for retirement. And the traditional IRA, the traditional sort of pre-tax 401k, was the original version of a retirement account. And then in 1997, something called the Taxpayer Relief Act came out. And part of that was this piece of legislation put forward by Senator William Roth in the great state of Delaware. By the way, that'll be a great Jeopardy question one day. So if you win because of that, let me know. Great little trivia tip there. And anyway, what he developed, or what he put forward, was that this idea of changing the tax structure of the traditional IRA. And so what we now have basically are two different tax wrappers for individual retirement accounts, as well as 401ks. So as far as the IRAs themselves, there are some similarities. Both account types will let you hold whatever you want inside, whether that's stocks or bonds or cash or mutual funds. The contents don't matter. What does matter is that wrapper, that registration, because what that determines is how the dollars are going to be taxed, which really is the most important thing. So with the traditional IRA, every dollar you put in, all of the new money, the contributions going into the account are treated like reductions in ordinary income, right? So it's essentially it's income that you don't have to pay tax on in the year you make that contribution, okay? And we'll talk about limits a little bit later. However, the trade-off for the tax benefit today is that all the growth, all the earnings, everything that develops in that account, when you take it out, it's going to be taxed like ordinary income, right? Every penny of it. Now, the challenge, of course, is that we don't know what tax laws are going to look like. We don't know what the bracketing will be. We're not really sure about any part of that. So there's a bit of unknown there, a bit of uncertainty, but it does give you that tax advantage today. And for folks that look for a way to reduce their taxable income, contributions to accounts like that can be a great way to get the job done. Now, what the Roth does is kind of twist that around and flip that tax strategy to some degree. What the Roth IRA does, it says that, okay, all of my contributions, the new money going in, are all dollars that I've already paid tax on, right? So dollars that would be in my savings or checking account that I've already, had taxes withheld from. And when I put that money in, all of the growth, all the earnings, everything that comes from that account over the years will never, ever, 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 ever be taxed, ever. One last one, right? Which is great, because in retirement, if you can create a bucket of money or an income stream or some source of dollars that you can use that you don't have to pay tax on, that's great, because it doesn't matter what the tax laws look like. It doesn't matter what the tax rates are, because it comes out and you can use it tax-free. Okay, so those are the fundamental differences. Now, what's interesting is that there is a way to move assets, to move dollars from a traditional IRA to a Roth, right? Because as you might imagine, the Roth account, the Roth tax structure is probably a little bit more desirable, and I'll talk more about that in just a moment. But one of the important things that we want to look at when we think about conversion is what's the end game? What are we trying to accomplish? And so the active conversion is pretty straightforward, right? The IRS basically says that you can convert as much as you want from a traditional IRA into a Roth IRA, right? There's no limit, because remember, conversion is different than contributions. So the thing about a conversion is that if you think of it like this, if I have my traditional IRA and my Roth IRA, I can take as much as I want, a little bit, or I can take the whole thing and put it into my Roth IRA, convert all of it. Now, the most important piece of this, of course, is that the market value of that conversion is taxed like ordinary income in the year you make the conversion. Okay, I'm gonna let that one sort of sink in for a minute. Okay, so if I were to convert $10,000 from a traditional IRA into a Roth, I would pay tax on the $10,000 as if it's ordinary income in the year that I make that conversion. But of course, going forward, all the growth from that $10,000 will never be taxed again. So it's kind of like you sort of, I think bite the bullet is the term from a tax standpoint, and that's it. And it never happens again. Now, if somebody wanted to convert, in an exaggerated example, $1 million from a traditional to Roth, the IRS would say, heck yeah, you can, absolutely. Because you'd have to pay tax on that whole amount like it's ordinary income. In fact, the IRS would probably send you a thank you card and a basket of muffins for doing that, because you'd be paying them way more in tax than anybody ever should, okay? But what's done more often is in small increments, converting small amounts every year to build up that tax-free bucket of money for retirement use, okay? Now, when you make the conversion itself, it can be a conversion of cash, it can be a conversion of mutual funds, it can be a conversion of stock, right? And so the way that's evaluated is that the market value on the day of the conversion is the amount that's taxed like ordinary income. So here's the thing to consider. Let's just say that I'm holding shares of a stock, right? I'm just going to make up a company no one's ever heard of before called Apple. And if you had 100 shares of Apple, right, and you wanted to convert 50 shares, and if you did that conversion when the share price was at a high, you'd be paying tax on quite a bit for the 25 shares you move that you convert to Roth. But if the value, if the share price was low, if the market were down that day or that month, some considerable amount, and the market value of those Apple shares had dropped significantly, if you move those same 25 shares, the actual market value that you'd be taxed on is much less. And then the good news is that all the appreciation from that point forward never taxed on again. Okay, so I think you get the idea. Now, when it comes to conversions themselves have to be done and completed in the calendar year. So it has to be done by December 31st. Even though you can make contributions a little deeper into the next year, conversions are limited to a calendar year, okay, to 12 months, and they have to be done by the end of December. Now, one other thing too, because this question comes up quite a bit about conversion. So I am over 70 or I'm over 72 and I'm taking RMDs. Am I still able to convert? Right? And so the short answer to that is yes, you can, with one caveat. And that caveat is that the RMD has to come out first before you convert. So if you think about converting, for example, let's say $10,000 from a traditional IRA to a Roth. If you are of RMD age, whether that already started for you at 70 and a half or 72, you have to first take out the RMD either from that amount or in addition to that amount to cover that RMD before the full conversion is done. All right, I hope I explained that correctly. So it can be done. Conversion can be done at any age. Now, the question that you ask yourself is it right for me? Right, which is a question that you ask yourself when you see these drug commercials on cable TV, right? What are the side effects? What might I see? So some of the side effects of conversion can be potentially paying more in taxes than you intended. Because if you're on, for example, a fixed income, and I know that my taxes are typically the same amount every year in retirement, and you convert a large chunk of money, well, that could move you up into a higher tax bracket. So that's a consideration. Okay, another consideration is the timing too, right? If you convert when you're younger in your 40s and 50s, you have plenty of time for recovery of that account or that asset after you've already paid the tax, if that makes sense, right? That reduction of tax from your net worth now has plenty of time to be restored and grow from that point going forward. But if you're going to convert later on in life and there's not enough time to recover the tax that you're paying in terms of growth, it may not be the best idea. Now, with that, I want to add one more point too. And you know how I like to talk fast, so I'm trying to get it all in under the wire here. One of the reasons to consider Roth conversion is for estate planning, right? And this doesn't get talked about quite as much, but it's pretty critical. And here's why. If you have a traditional IRA or a 401k and the account owner passes away, ultimately, the entire account is going to be taxed when it's distributed, right? The beneficiaries will inherit the account, whoever that's going to be, but in some way, shape, or form, all that money will come out and be taxed like ordinary income, okay? Now, if it's a Roth IRA and an account holder passes away, there's going to be a beneficiary in that as well. But guess what? That money, whether it can stay in or if it has to come out in a sort of a beneficiary IRA sort of registration, whatever the timing on that is, doesn't matter because you'll never pay tax on that account. So if you're trying to pass on assets to heirs in a sort of tax sensitive way, the Roth IRA can be a tremendous tool for that. Okay. The other consideration, I guess the last consideration to bring up too, is determining the best time of year for a conversion. All right. And this is a little tricky, but it is one of the reasons why we bring it up towards the end of the year. So generally speaking, for individuals that have had a similar income year over year, you have a little more flexibility on when you might want to convert because you know what your income stream looks like. You have a good sense of your tax rates. And so you know the impact it's going to have. For individuals that are still working or maybe get an end of the year bonus or their pay is a little more sporadic, it can be a little trickier to know when the right time for conversion is. But as we get closer to the end of the year and you as an income earner have a sense of what that income begins to look like, we can begin to figure out what the right amount for conversion actually is. Okay. And if you can imagine a scenario, as I mentioned before, where we're doing small chunks every year, right? Or converting over a longer period of time, that's going to allow us to really build that tax-free bucket in the most sort of tax advantageous way that we possibly can. Okay. All right. Hope that makes sense. Now, the last thing I want to mention too, as far as things that we think about at the end of the year, is have we maximized our contributions? What are we able to contribute to our different retirement account types? And so just as a quick review, to talk about a few of them, the IRAs, the individual retirement accounts. Now, right off the top, the limit that you can contribute is $6,500. If you are age 50 and over, you can contribute another $1,000 on top of that for a total of $7,500. Now that I said that, what I do want to mention though is that if it goes into a Roth IRA, there are some income caps, some income considerations to kind of think about as well. As far as 401ks, for those of you that are still working or making 401k contributions, the contribution limit for 2020 as it stands right now is $19,500. Okay. Now that's not the amount that your employer can put in to match. That's what you can determine from your own income that can go into a 401k. So if you've been contributing over the course of the year and you're going to fall short of that and you want to make sure that you get your maximum contribution, that's something that you can talk to your 401k administrator about to make sure that you can get it fully funded by the end of the calendar year. Okay. And on the 401ks, if you are age 50 and older, there is the catch-up contribution for that account is $6,500. So in theory, you can contribute up to $27,000 out of pocket if your cash flow allows, to make up for some time and really make sure that you're taking advantage of all the benefits of tax-deferred growth or tax-free growth in the case of a Roth. So I think that's where I'm going to stop. I wanted to keep it sort of high level, but give a lot of information in a short period of time, as I often do. And so if there's questions, let us know. But I think with that said, I'm going to turn it back over to Brandon to close us out.
All right. Thanks, Adam. That was great. I think the reason that's so important and why we wanted to share it is with the end of the year approaching. So hopefully that's helpful. I know we've talked to a lot of you guys about this already, but just I think a good time to refresh a little bit on this stuff as we get close to the end of the year. So thank you guys all, as always, for joining us. Hopefully this was helpful. Hopefully you got a little more out of this, and these kind of timely quarterly updates are helpful for you. We will look forward to seeing you guys again. The next one will be, I guess, 2021. So hopefully that's a year with a little more optimism ahead of us and some better news on the forefront there. But in the meantime, enjoy the holiday season. Hopefully we'll get some more sunshine here so we can still do something and get outside of the four walls a little bit. But enjoy the holidays, enjoy the family time, and we will see you guys all soon.
Don't catch Zoomitis. Don't do it. Bye, guys. Thank you very much. Have a great holiday season.